Hello, guys. Once again, my name is Joseph AGK Oji, and tonight, today, I'm going to keep you company, and we begin where we stopped from the previous lecture. Um, in my previous lecture, I introduced you to the financial statements of company or organizations, and I gave you the examples of the three financial statements that we have: the balance sheet, the income statement, and the statement of cash flow. I also explained that the balance sheet basically tells you the vital signs of a company. If the company is making money or not, if the company is a good investment that you can put your money into or not. Basically, with the financial statement, you can tell the story about the company from the beginning to the end. So now, in this lecture, I would have start to show you how to use financial statements to evaluate a company's performance and to decide whether to put your money there or not. Now, this is not difficult. The good thing is that we have software like Excel that make it easy for us so that anybody can do it. So I'm going to go slow, make it step by step so that you can now follow me along. I'm going to share my screen so that we can begin the long journey of evaluating a company's financial statement so you can see how it is done. And I'm sure that you are going to enjoy this lecture. So let us begin. So starting from today and the coming weeks, we'll be looking at all these things: cash flow, net cash flow, free cash flow, performance evaluations, corporate tax schedules, and analyzing financial statements. For today, we'll be looking at cash flow, net cash flow, and free cash flow. Then the subsequent lectures will now delve into these areas. After that, we can now look at one area that is very fundamental to finance: the time value of money. So let us begin with cash flow, net cash flow, and free cash flow. Okay. Cash flows it's just like just like the money we have after expenses. Well, cash flow basically means the money that is coming in and the money that is going out. So for a corporation, it means that the money that is moving in and out of the corporation in a month or in a year. Just like when we work, we get paid, and then we pay our bills. So money coming in from you and money used for your expenses and bills is your personal cash flow. For the company, is the corporate cash flow. So cash flow is the net amount of cash and cash equivalent being transferred in and out of a business. Now, this is very important because a company's ability to create value for shareholders is very, very, very fundamental, very important. And that is determined by the ability or the company's ability to generate positive cash flow. Just like you on a personal level, if your amount coming that you are making is less than your bills that you have, you'll be in trouble. The same thing with the company. If they are generating less money than they are putting in, the company will be in trouble. So that's why this is a very important concept in finance. And when analyzing companies' financial statements, you look at things like this. So that the stream of cash flow that a firm that generates in the future determines the value of the company, what they call the intrinsic value of the company. Okay, I just want to make sure that you are seeing this. Now, okay, let's see. Now, net cash flow simply means the difference between the company's cash inflow and company's cash outflow. How much is coming in, how much is spent. That means the simplest way of saying is that the net cash flow means the change in a company's cash balance as detailed in the cash flow statement. Okay. Now, sometimes we call it change in cash and cash equivalent, the net cash flow. So how is it calculated? The formula we use for net cash flow is simply cash flow for financing, for operations. This is CFO, means cash flow for operations, cash flow for investment, and then cash flow for financing activities, and any other adjustment in cash flow that we need. So having said that, I'm going to show you how we can calculate it using a company that I called is a utopian company. I have to tell you. So that company is it's called the Dominion Plastics Incorporated. You can see right here, Dominion Plastics. So the net cash flow for this company in 2021 is calculated as follows. I will take you to the balance sheet of the company. We can have it right here. Okay. So you get it from the cash flow statement of the company. Let me see. Okay, you see. Okay. This is blocking me here. Okay. Just 1 minute. Let me move these things around. Okay, this is the cash flow for the companies, for the Dominion Plastics. So you can see it right here. So now, to get the net cash flow for this company, all you have to do is, I've already calculated it here, but I'm going to show you. Let me make it a little bit bigger. Good. Now, again, let's look at the formula before we do it, because I want you to follow me along. Formula is cash flow from operations plus cash flow from financing activities, from investment, and then cash flow from financing, which means that for Dominion Plastics, net cash flow is equal. Again, before you do any calculation in Excel, put the equal sign, which will put this cell in a ready mode to do work. This is the total cash flow. Everything here is in millions. For example, this is 228, means $228 million. So you can see the net cash flow from under the cash flow from operating activities. Okay. Now you can see the net cash provided by operating activities. You click on that, plus. So you can see the work we're doing here. We put plus, everything we show on the screen here. Plus net cash from investing activities, which is this one, plus, and then net cash provided by financing activities. Yeah, this. So you can see the -10, which means -10 million. Remember, all these things are in dollars. You can change them to dollars if you like. See, -10 million. That means that they are spending more cash than they're bringing in. That is not good. That is a bad sign. However, if the company is growing, is expanding their operations, in making more investment, growing, they might have a negative net cash flow for a while. Amazon, company like Amazon went through that. Many growth companies went through that. Once they have attained a certain growth level, they can now start bringing more cash than they are, spending. So let us go back to our PowerPoint and continue where we stopped. So you can see how we get this -10 million. So this means that the net cash or cash flow from net cash flow for this company, Dominion Plastic, it added -10 million into the cash balance in 2021. So which is not good. Now, I'm going to tell you this. Why does net cash flow matters? One, the first reason is that it helps company to expand. If it is a positive net cash flow, the company can use it to expand their operation, develop new products. Like Apple, for example, might use it, their net cash flow, to do research and development and bring a new iPhone, new iPad, or something like that. Or they can use it to pay dividends for those companies that still pay dividends, or to reduce their debt, which is very important as well. So, in other words, in fact, this is why some people value net cash flow more than just about any other financial measure, including earning per share. Some analysts some investors value cash flow, net cash flow, more than earning per share. Because if you're negative over the years, it continue to be negative, there might be trouble somewhere. As a matter of fact, there are some investors that what they do is to go through financial statement of many companies, looking for those companies that have high net cash flow, but low share prices. Their cash flow is good, but the price of their share is low. That means that this is a good company. For some reason, the market has not recognized it. So those shares those companies that have positive net cash flow over the years, but have low stock price, mean that the stock prices has value. So they buy it and hold it for like 2 or 3 years. Then by that time, the market will recognize the company. Then the share price will skyrocket and they sell it and make money. Anyway, I'm sure you get the point. Now, let's look at the next one, which is free cash flow. Very, very important. The simplest way to understand what free cash flow is you on a personal level, let's say you make $3,000 in a month, but your expenses and bills is $2,000. So your free cash flow is $1,000. This is money you have that you can spend any way you like. If you like, you use it to go vacation or to do some other project, maybe help some dependent relatives or do a project, whatever project it is, or even buy more stocks. At the corporate level, it's the same thing. So it means the cash flow available for distribution to all the company's investors after the company has made all investments. So, like I explained in the previous slides, the interest value of a company's operation is determined by the stream of cash flow in that operation that generate that in what the operation generates. Now in the future, what it generates now and the future. So managers, what they try to do to increase the intrinsic value of a company is to increase the cash flow now and in the future. Do projects that will increase the cash flow now and in the future. Okay. So how do they calculate cash flows? There are two methods where some analysts use different methods. That's why you see one analyst will be looking at the company. They say this company not good. Another analyst will say this company is good. And so because they are using different methods. So I'm going to show you two methods. The first method is simply you get the free cash flow by subtracting the capital expenditure from the cash flow from operations. So that means free cash flow. The formula is free cash flow is cash flow from operations minus capital expenditure. So this method is too simple. It's just like calculating the gross profit. It doesn't give us much. It doesn't tell us much about the company's cash flow. And when we talk of capital expenditure, what are we saying, or what are we referring to? Well, in the simplest term, capital expenditure, some people call it capex. Well, what they mean is they are those funds that the company used to acquire, upgrade, or maintain physical assets. things like property, industrial buildings, equipment. So in other words, everything from repairing a roof to building, to purchasing a new equipment, or to building a brand new factory, all those things are capital expenditures. So let's see how that works. It says, question 1 says, calculate the free cash flow for Monarch Casino and Resorts Incorporated for the years 2014 to 2017. So to do that, I'm going to remember the formula: cash flow from operations minus capital expenditure. Let me take you to the financial statement of Monarch Resorts. Let us see. See Monarch Resorts. I hope you can see. Let me make sure you are seeing all this. Yep, you should be seeing this. I believe. So this is the Monarch Resorts. One more time, I want to make sure. Okay, good. Good. See the Monarch Casinos right here. Let's see, that's right. So now we get this from the cash flow statements. Now we have let's say this is the free cash flow. Free cash flow. Cash flow. What you call FCF for Monarch Casino and Resorts. This is the cash flow statement for the years that they're giving us, 2017 all the way to 2014. So all you have to do, one good thing about Excel is you do one calculations. You can copy the formula and it will do the rest of the calculation for you. So for Monarch Resort, free cash flow equals the you have the. I think I can put the formula here for you so you can see. Yeah, I think that should be good. Let me see if I can do it. Let me see if I can do it so that we can just do the computation. Okay, let me copy it from here. Okay. And then come here and put it so that you can be looking at the formula while we're doing it. We're here. I'm gonna, okay, let me see, escape. Good. Let me put this thing so you can see the formula. Maybe I can put it on a box. On a box. It takes, okay. Now, I'm gonna make it a little bit bigger. I want it to be okay. Cash flow from operation. Let me make it okay. Okay, let me arrange this first. Cash flow from operations. Yeah, that's better. Make it 14 probably. That would be better for us. Yep, that's good. Now, we have equals cash flow from operations. You can see the cash flow from operations right here. Total cash flow from operating activities. Okay. Then you can have capital expenditures minus capital expenditure, which is right here. See? So cash flow for operation minus capital expenditure, you can see the formula at the top. That gives us the free cash flow for this company. So you can see it is, give me 1 minute. Let me make sure I can just 1 minute. So you can see that for this company, once you calculate it, we can just move it to the other years, and it will give us the cash flow And like I said, these are all in dollars. So you can see that this when you check out this company, let me make it more clear. You will see that 2014 they have a positive free cash flow. All these are in millions. 2015 it is going down. It went down. Then it jumped in 2016. Then went negative, completely negative in 2017. You know. So when you check this over the years, you can see if the company is how it is performing cash wise. But this method is so simple. It doesn't tell us a lot about the company. So that's why I want to show you the other method. That method contains more information, and then I recommend that method. In fact, but if you're in a hurry, then you can use this method and get it over the years. Now, method 2. For this method, we are going to calculate many things. It's just like this method is similar to finding the net profit because you factor in other variables that will tell you the true picture of what the company is, cash-wise. So for this method, we have to calculate the free cash flow. We need to calculate 4 things. 4 things. One is the net operating profit after tax. Second one is the net operating working capital. Third one is the total net operating capital. And then the fourth one is the net investment in operating capital. Once we have this, we can now calculate the free cash flow using this using the formula here by saying that the free cash flow is net investment in operating capital, net operating profit after tax minus net investment in operating capital. That will give you the free cash flow for the company. So let's begin. Let's start with the first one. Let us calculate net operating profit after taxes. For that, I'm gonna take you to the company we're using, the Dominion Plastics. So let me take you to their income statement where we put most of the information we need. So Dominion Computers income statement. So to make things easy for us, I have already put in all this information, the tax rate. So let's assume that the tax rate is 40%. That's what I assume. And some of you might say this is too much. This is too much. Well, the corporate tax rate in the US has been high for a long time. As a matter of fact, our new president just increased it to that. He's trying to increase to about, I think about 20-something%. It used to be 40. Let me show you something that will give you the idea of where the corporate tax rate in US was before President Trump came in and then brought it down. Yeah, I'm going to show you, right? I think it's right here. You can see that over the years, 2000, it was like 35%, 35. Then when Trump came in, it brought down to 21%. So in 2018. Anyway, for the sake of our analysis, I will show you both ways. I will do it with 40%. Then I will show you what it will be if it is 21% that it is currently today. Okay. Anyway, let's say. So the first thing is to find this net operating profit after tax. Net operating profit. Excuse me. Okay, net operating profit after tax, which I called NOPAT. Okay, and the NOPAT, the formula is earning EBIT. This EBIT means earning before interest and taxes times 1 of the tax rate. And like I told you, for the sake of our analysis, I assume that the tax rate for the minimum plastic is 40%, which is 0.4 and 0.4. So this is for how many? For year 2021 and 2020. Now, like I say, when I finish, I will show you what the outcome will be with a different tax rate. So that no part will be earning before interest and taxes, which is right here. Earning before interest and taxes, click on that. Okay, times, okay, one minus the tax rate. And the tax rate for us is 0.4. Okay, got 300 million. And then you can just copy it from here, give you 330 million. Now I have calculated the first variable. Now, the next variable that we want to calculate will be the, I'll take it there so I can show you the next variable we need to calculate, which will be the net operating working capital. Okay. So net operating working capital is we use it to assess the company's liquidity. So we get it by subtracting current liability from current assets. In my previous lecture, I explained that current assets are assets that can be easily converted into cash. And then, and the current liabilities are liabilities that are due within 1 year. Now, but when calculating net operating working capital, when we're picking current assets, operating current assets, we're looking at operating current assets. That asset includes cash, amount, account receivable, and inventories, but it doesn't include marketable securities. And then operating current liabilities includes accounts payable and accrual, but it does not include short-term debt, which is part of the current assets. So you only use those current assets and current liabilities that are involved in operation. A simplest way of saying this is this: if an asset pays interest, it is not an operating asset. And if a liability charges interest, it is not an operating liability. Okay, so based on that, we have the net operating working capital will be operating current assets minus operating current liabilities. Okay, now operating current assets involve cash, account receivable, and inventory, minus account payable and accrual. So I'm going to go to the balance sheet and get those information and transfer it so that we can calculate the net operating working capital. Okay. Excuse me. So let's go to the balance sheet of this company and then get those operating current assets and operating current liabilities. Okay. So I'm gonna take you there. The balance sheet is, make sure you're seeing this. The balance sheet is here. Let's see. Yep, right here. So let's look at the operating current assets. Okay, maybe we have put the equal sign. Operating current assets will be cash plus, I'll put it this way, plus, you cannot put short-term investment because it earns interest. So you put account receivable plus inventories. And then you can copy it to the next year, previous year. And repeat the same for the operating current liabilities. Operating current liabilities, to go and put it here, it includes things like account payable plus, you cannot include note payable because note payable ends, you have to pay interest on that. It does not directly involve in operations. Then plus accruals, accrual expenses, for operations, you have to pay wages, pay bill, energy bill, and so on and so forth. So that's why we include it. Okay. And then you copy it to the this way. Then let us transfer them to our income statement where we do our calculations. The free cash flow. Okay. Sorry, the cash flows. Income statement. Let me see. Okay, right here. So I'm going to put them here. Oh, excuse me. I copied the, I put the wrong. I want to about copying. You have to be careful how you paste it. So let me do it again. I'm going to take you back there. Okay, where the assets, here they are. I'll copy it from here. Okay. So when I paste it there, I'll be careful. I'm going to paste it here. Right click. So make sure you choose the numbers here so I can paste the values. See? Now they are in. With this, I can now calculate the net operating working capital equals operating current assets minus operating current liabilities. And that will give me the net operating working capital, which I will copy down to this side so that it will calculate for the previous year, okay, which is 2020. Now, let's look at operating long-term assets, which will be the next thing we'll calculate. So for the operating long-term assets, we have to, sorry, not operating long-term assets. We're talking about, next thing we need to calculate is the total net operating capital, okay? So that is, for that, we use this formula, net operating working capital plus operating long-term assets. So now, the operating long-term assets for this company, you have to get it from the balance sheet. So I'm gonna go there and get the operating long-term assets. So let's see, balance sheet. The only operating long-term asset we have here is net plant and equipment. So I will just copy it from here and then go to the Dominion computers, sorry, Dominion income statements and paste it. Again, remember we are pasting to paste, oh, you didn't give me paste. Okay, let me see what happened here. Okay, let me see what happened here. You need to show me the paste options. Let's see, let's try it again. Balance sheet. We copy it from there. But I didn't copy it, that's why. Okay. Copy. Okay. And then income statement. Okay. You give me the option here to choose the values. So you press the numbers. Now, having done this, next thing we do is to do the calculation of the total net operating capital, which, like I told you, the formula is net operating working capital plus operating long-term assets. Okay. So let's look at it. So you have equals net operating working capital is right here. Click plus operating long-term assets. Okay. And then, we can now copy it over here. Now, one more variable we need to calculate before we can now round up with the free cash flow. And that one is net investment in operating capital. Net investments in operating capital. So net investments in operating capital simply means the difference between total net operating capital in the current year and total net operating capital in the previous year. Okay. So once we have that, we'll be ready to calculate the free cash flow. So let's see, which means that here it should be net investment in operating capital will now become equals the current year minus that in the previous year. Okay, 560. Remember, all these are in dollars. Let me make sure I have dollars in dollars so you can see. Okay. Now, with this, having gotten this, we're now ready to calculate the free cash flow for year 2021. Okay. Now, so equal. So the free cash flow, before I calculate it, I want to show you the formula. It's just gonna be NOPAT. NOPAT means net operating profit after tax minus net investment in operating capital. Okay. So having said that, we can now go there and calculate it. NOPAT will be equals net operating profit after taxes. That's the free cash flow. I mean to say. Let me, as a matter of fact, let me make it tick, because that's meant while calculating here. Okay. So you're gonna be equal net operating profit after taxes minus net investment in operating capital. Say negative 260. This is our free cash flow right here. Now you can't get it for this year because you can't get it for 2020 because we don't have 2019 data here. So it's negative. No wonder the net cash flow is negative. Something is wrong. So this will tell you to dig deeper into the company to see why is it negative. Is it because it's expanding or their operation, or is it because of, they're not making sales or not? That is how we get free cash. And you can see that this method, as I use now, involve many steps and give us a true picture of what the free cash flow of the Dominion Plastics Incorporated is. It's negative. Something is wrong. Now, I'm sure you enjoyed this. If you're having problem with it, please watch it again and see if you can figure it out by following my steps. Now, suppose one thing I want to show you before we leave is this. Suppose the tax rate, like I explained a few minutes ago, when Trump came in, he brought the tax rate, corporate tax rate down, brought it down from 5% to 21%. So to put the tax rate is 21% for this company. Let's see the effect it will have on the free cash flow. So for that, I'm going to take you to the chart and change this tax rate. I want you to look at watch here. I'm doing it to 0.21. Okay. So to 0.21, 0.21. You can see before that the negative cash flow is the cash flow was very the negative is so high. I mean, it's 260 million. Now, when we change this to 21% tax, it brought it down. So you can now know why companies went crazy. The stock market was booming as that Trump produced the tax rate. So just the reduction in tax rate alone, you can see how it affected the cash flow. Okay, suppose it is 10%, 0.10%. Okay, see, to bring it down. So even though it is negative, it is not too bad. Now, let us see what happened if we put it the corporate tax to the level it was before Trump came in, at 5%. Yeah. Now you can see how it will have on the corporate tax. Free cash flow 0.35. I want you to watch here. You will see that it will jump back to 25, 205 million. That's a lot of negative cash flow. And of course, if you change it back to where we were before, it will go back to what it was, which is 0.4, 260 million like before. Okay. Now, with this, let me show you. What companies use free cash flow for. Okay, and then that will round up for tonight. But for today, I mean to say, a company uses free cash flow to pay the interest to debt holders if they have debt. No, every company have debts. Okay, so they pay down the interest or pay off some of its debts, or you can use it to pay dividends, you know, or to shareholders, or even buy short-term investments, or even go into projects that will boost the value of the company in the future. So now the so there are some few things we need to know about the free cash flow. The free cash flow, the impact is very big on the company's value. So managers and investors can use free cash flow as a component to measure how good the company is performing. A negative cash flow means that the affected company is really going through problems. But if the company have negative cash flow, but they are making large investments, in new projects that will increase value in the future, they will still have a negative cash flow. That doesn't mean that a negative free cash flow is not bad all the time. Good example is when Amazon was expanding their operations, investing in a lot of technology, their cash flow was negative at some point. But after those investments, the cash flow is now being positive over the years. Okay. Now, in our next lecture, we'll looking at the performance evaluation, some of the key performance evaluation we use to evaluate financial statement of a company or check the value of the company. And then, of course, after that, we now start going into financial statement, more analysis of financial statements, things like ratio analysis and so on and so forth. Thank you for listening to my lecture, and I hope you enjoyed it. And I believe and I hope you will see you in my subsequent lectures. Thank you again. My name is Joseph Ejikoji, and you have a good day.